Good evening, this is Nick Imnan from VolumeProfileTrader.com on Saturday, December 31st, and in this video we're going to cover the dollar, the euro, gold, silver, copper, the Dow, Nasdaq, and the 10-note Treasury. And I want to get a perspective of, or I should say a game plan for 2012, and I want to reflect back on what's gone on the last couple of years and the recent price action that we're seeing now, and build a thesis around it so you can develop a trading thesis or a trading plan for the year. And obviously that plan, just due to price action in the market, it's going to have to be adjusted, but you have to start somewhere. You have to have some type of concrete, not formula, but concrete base to build off of so you can improve and you can measure your progress as a trader. So I think that's important, and that's why we're going to, that's why we've been covering a lot of stocks this weekend, covering the S&P really in depth, and now we're going to basically look at the other future contracts or indices that matter and have a weight on the market. So I want to say that this is the last video that's going to be in detail this length for basically for free, whether you've been watching on YouTube or sent out through emails through registering free at VolumeProfileTrader.com. And starting in the new year, we're going to only be providing premium videos for paying members, but we are also going to have free videos for those who just want to stay, on the free mailing list or watch on YouTube, whatever. The video just won't be as in depth. It's probably going to cover one name, whether it be the S&P or something else, and hopefully a trading idea so you can perhaps make some money on it too, because that's what it's ultimately about. But it's just to the point where it's not going to be worth it if I keep giving it out for free, and I'll just go back to day trading and trading the markets basically to myself. And so I just want to let you know that. So if you're interested in becoming a member, then go ahead and after this video, go to VolumeProfileTrader.com, and you can either get the package with the trading room, and we're running a special price on that, or you can just get the one for the video and updates throughout the day. That's our least expensive service, and it's probably one of the better ones out there. Definitely the best bang for your buck. I agree. That's the case with the trading room also. If you have the time to go in the trading room and perhaps take a few trades with us. So, anyways, honestly, enough of that. Let's get this video going, because now that I'm 3 minutes in, I'm boring you to tears, and all you want to see is basically what's going on in these names that I've mentioned. So starting off with the dollar, this is the yearly chart. Point of control finished at the bottom of the range. Ultimately, the year for the dollar was a bullish year, and we finished positive on the year, just slightly. And also, you could have made a ton of money on both sides of this trade. In the beginning of the year, it was an easy short. It was any rally was being sold into. In the summer, we based, and we formed a nice high volume area. We broke out. We really had a huge overshoot to the upside, probably a lot of short covering, and we tested the breakout right at the point of control. We had a great bounce and a nice rally to year's end. Now, despite the great move the dollar has had, we did not make new 2011 highs, but we're really close enough. And what we're looking at now is, will this sell off at this resistance level, or are we going to continue higher? And I think it's appropriate to move out one more year and see that you have the point of control for the last 2 years up at recent price range. If we start dropping below 80, we're going to go retest the 78.50 level. There's not enough volume between 79 and 80 to keep the dollar in that range. We're either going up to 82 and above, or we're going down to 79, 78. So it's important to realize that. And right now the point of control is at the top of the range. So the way I see this is, overall, definitely, since for the last 2 years we're not even close to the highs for the last 2 years. If you really want to, I'm just curious, just what the Fibonacci's are, just for a reference. And let's see, up at 50% or so retracement. So we're in the middle of this move, and point of controls at these current levels, value area high. You can see once we, if we get above 81.50, there is no volume from keeping us to going above 83, and ultimately up to the 86 to 88 levels. So it's just something to be aware of. But if we're going to go back within value, right now we're at that top of that range, we look down towards 79, down to 77 for a potential downside move. One thing else to recognize is, let's see if I can get one. Really, last time, let me get rid of this Fibonacci nonsense. Last time the market was this extended above this this moving average was really around right there, and it kept going in that circumstance. But it looks like this is a little different. If we were above 82, I would say, yeah, we probably have more upside. But I'm really skeptical about this, and I think the dollar has more downside, which means usually that means the markets, the equity markets, are going to rally. So I want to bring in the hourly chart to put a perspective on it. And the December point of control finished at the top of the range, and also relative to the last couple of months, at which we've had overlapping volume, there's not a lot of volume relative to volume down here on this composite. And the fact that we closed below December, this 80, let's go to the very top end and call it $81. If the dollar gets back above there, I would really be surprised. But really what we're looking for is around 80.20 on the downside, and then really get going back down towards this 78 level. It shows better that there's no volume after it breaches this $80 level. It's literally nothing, and it's going to be easy for the dollar to move down $1 or $2 in probably a couple of days, just for the fact that there's no volume that's going to battle this price range. Okay, it's appropriate to cover the euro also, and the euro just continues to move lower. It kind of looks, it definitely does look like the inverse of the dollar, where, let me zoom into the yearly chart, where it was an easy long at the beginning of the year, and from there on out, from summer, it definitely traded flat with a downside bias. We had a huge breakdown, a nice move to the downside, a rally up to the point of control for the last year, and since then it's been downhill. So we're probably at a potential low on the euro, just like a potential high on the dollar, just because we're back at the 2011 lows. So that may mean something. So overall, it's just something to keep your eye on. As far as the volume profile on the year chart or the 2-year chart, it looks more interesting to be a seller of euro on strength rather than basically selling the dollar or buying the dollar here. And I think that it's going, basically what the euro is probably going to do is have some type of relief rally, short term or short covering up to the 134 to 138 range, and from there you reevaluate the euro and probably look to get short again for a nice move again to the downside. So it's just something to be aware of. It's, to be honest, it is a cheap shot here to the long side, because if you want to have your stop below the 2011 lows, that's perfectly fine. Just realize you're having a stop below the 2011 lows. If I bring in the monthly chart, and I have a lot of lines drawn, and let me get rid of them. What we're looking at here is a nice bounce off of the 128 level. We've had a nice series of higher lows, and we finished the week strong. So if this thing can continue to push up, it should get, a little bit of momentum to the upside, at least up to 136 and 130.60, I should say. And from there, if we can get above those levels, then the euro is really going to move higher, just like how the dollar is. If we move lower on the dollar, we're going to move higher on the euro, and it could produce a nice move if we can break this, call it 131 level, to really be on the safe side. So it's just something to be aware of. Okay, gold, this is, I'm playing a little bit contrarian to the trend right now as far as the short-term trend. I think gold is at a great buying opportunity. Right here, right now, you have the year point of control. We're bouncing off that almost to the dollar, and off of that move, we've rallied almost $50, about 3 or 4%, not bad. And what we're really looking for, if you can, manage your risk based off the lows that we've had, that's great. But what I'm more interested in is see if we get a higher low, some type of retest and a successful bounce, then I'm going to be interested. But I like the fact that we're bouncing off the point of control. It shows that through this year of trading the gold futures contract or GLD, whatever works for you, that really we just came back to value. We came back to that highest volume price traded for the year at 1525. We had a huge rally, and all we did was retrace back to value. So despite the fact that people think that gold's in a bubble, gold's going to break down, it may continue lower, but I like the fact that we can really define our risk here. And if I zoom out one, the only thing that's concerning is the 2-year point of control is a little bit lower, and the current volume that we're trading at, the 1-year point of control, it's at this 1525 level. It's light relative to this 1386 level, and this could, what it could do is produce some type of higher low, and then maybe we go down to test 1400 to 1380 or so. And that's the level I think that really matters to the long side. But for now, I think the path of least resistance for the gold contract, gold in general, is to the upside. And I'm going to bring over the hourly chart. We're not yet out of the woodworks. It looks a little bit like the euro, where we've just had a rough December in gold, unless if you've been short this. And what we're looking at here is a nice, it was off $1.10. It overshot the point of control for the last 2 years. And what we've seen since then is a nice bounce, and we're looking for some type of retest. And if it doesn't retest, even 1550, what's that telling you? It's telling you that people are looking to buy back either their shorts or to buy gold at any level, that it prints that day. And we're going to go and test 1590 up to 1620 or so, 1615, and with an emphasis on 1600, 1595. If we can get above that level, close above 1600, that could produce a nice bounce in gold, and I think it's something you want to be a part of. Why? Because we're bouncing off the 1-year point of control, so it's a bigger time frame move. Therefore, your expectations should be bigger, which means around 1700, maybe that's your target for gold on the upside. Okay, silver, on a 2-year chart, it looks bad. Point of control at 1850, I mean, we're not even close to those levels, so it's really ignore it. Let's look in a little bit. We have new 2011 lows, so after this huge run-up we saw in silver, all we've seen since is opportunities to both the short and long side, but ultimately lower highs, lower lows, and it's definitely negative for silver. If I had to pick between silver and gold, I would pick gold just because of the price level it's at, and basically we've had a nice pivot off this 35 level. One being a buying opportunity back in the midsummer months, had a nice run higher. Then we totally pierced through that level and tested it again, and that was another selling opportunity. Since then, it's been a nice short. So it's great to use these big reference points, these long-term reference points, as an indicator, because if you're on the right side of the trade, the bigger time frame volume profile chart should correlate well. So if I bring up silver on a monthly chart, we've had a really nice reversal off the bottoms, and it's something to pay attention to. However, you would have to put your stop under those lows, and right now we're almost approaching $2 above those lows on a $27, $28 futures contract. So it's not like this is, it has a decent amount of risk to the downside if you were buying here. What you would like to see is some type of test back towards at least 27 or so, and look for some type of bounce there. But there's a lot of pain in this chart. You have a lot of downside. Maybe they all got washed out here, and this is why we're getting complete rejection. If we continue to see a higher movement and we close above 29, 29.5, that means that this entire down move was rejected, and price was too cheap there. Therefore, you can have a stop below this. Let's say it goes up to 29.5 and then comes back down and starts to bounce at, call it 28.50. You can put your stop below 28.50 because this entire move got rejected for now. Therefore, why would you have your risk anywhere lower than basically the support level that's held, excluding the breakdown? So it's just something that you should be aware of in terms of risk management. As far as being long silver, though, I think you just stay away, let it play out. Copper, this is a name that it was the right name to sell this year. And since 440, 430, the balance range that we saw at the beginning of the year, we had one breakdown from that level, a test back, and basically testing the top at 450, the top of that range, and from there has had a pretty decent sell-off to the downside. And what we're seeing now is a base. We would like this thing to break higher. One thing to be aware of is, though it's not the point of control for the year, this, 338 to 334 level, that's your biggest volume area in this current balance range. We're holding that right now. That's pretty positive for copper. What I really like about copper is the 2-year chart, and you can see we're at the point of control. Look at this. By far the biggest volume in copper in the last 2 years is right below the current levels that we're trading. We continue to have higher lows off the October lows. We have these 2 lower highs that we're dealing with. But if we go and test 3060, this could be a real move for copper. And let's bring up the 90-day chart. Basically, what I look at is this October point of control. It's done a relatively good job of holding price and where buyers want to be basically taking positions, and we aren't far off those levels right now. The only thing that's troubling is December's point of control finished at the top of the range, so we're definitely going to have some resistance around 355 or so on copper. But so long as that 2-year point of control is below us and we can really continue to make higher lows, I think this is something that you want to look at for a decent opportunity in 2012. Just one name that comes to mind is Freeport. I think this is weak. However, just like on the 2-year chart of copper, Freeport at the point of control for the last 2 years, if I bring it into the 1 year, it's similar to copper. Hence why Freeport is like what pros call the copper ETF or whatever. The Dow, it finished above its point of control for the year, though at the very top of this huge high volume area before volume really peters out, which is the 12,250 level or so. I think that's just a level to be aware of. And to the downside, really this 11,800. The Dow finished positive for the year, I believe, up around 6%. That's pretty good, and we like to know that because we want to be a part of things that are outperforming. So one thing that I like, the 2-year chart, we had a great bounce off of the, well, let's see, what happens if I bring in a 3-year chart? Okay, look how nice that looks. We had, back in October, August and October, we've had very nice bounces off the 3-year point of control, around 10,200, 10,400. Both times this year, bounced off it. We had a nice move in October, and then a retest of, look at this huge high volume area at 11,000 or so. We've had a successful bounce off those lows, and since then, we've made another higher low. So it's just something to be aware of. The Dow's definitely looking good, and so long as it continues to make higher lows, it's probably something that you want to be a part of. As far as, names, look at the stocks that we covered in the other video. So I think the Dow looks pretty good. I'm bringing in the 1-hour chart, and I see the December point of control. We've finished right at those levels, closing above it, which is positive. I think you give this not too much wiggle room, but you look at 12,000 as your line in the sand. It's the bottom of December's high volume area, and it's also the point of control for this 90-day range. Sorry about that. This 90-day range, and it's just something to keep your eye on. So as far as having a bias towards the Dow or anything else, it's not that. It just looks pretty good for the year, considering how the market traded. So we should look at the Nasdaq now. In the Nasdaq, people, they keep talking about how you should sell into the strength of the Nasdaq, and I'm not necessarily disagreeing with them. However, it's been right to buy every time at the value area low for this year in the Nasdaq, and around 2,200, 2,220. And yes, we've dropped below there, but I'll show you on a 2-year chart. I'll do that right now. That we didn't even come back to the balance range that we saw in 2010. Rather, we've made a pretty nice higher base, and if we can push back up towards 2,400 on Nasdaq, it's probably going to bode well for the entire market. We will probably see new highs relative to the rally since market bottom 2009, March 2009. We'll probably see higher levels, and people will probably make an argument for some type of inverse head and shoulder pattern on the Nasdaq. And the reason why is because you just have a series of, you have a low and then another low, which is, left shoulder, head, right shoulder, the move, let's call it 2,000 to 2,400, so you'd have a 400-point move to the upside. That's pretty good, and it's something that you're going to want to be a part of. So let's look at the hourly chart, 90-day chart of the Nasdaq. Point of control finished in the middle of the range for the month. That's usually a sign of just balance, which is fine. The only thing is, we have, let's see, back in, let me scroll over. We had point of control, higher point of control, let's see, higher point of control in, so August point of control, higher point of control in September, higher point of control in October, then lower point of control in November, lower point of control in December. So the trend short term remains to the downside, but there's your resistance level, I guess you could say. Really just looking at this 2,300 level. If we can break that, that would be nice, and it should bode for more upside in the Nasdaq and the entire market. So the last thing I want to cover, last name, the Treasuries. And I already have lines drawn, but really what I'm going to do is zoom out and look at the 10-year chart of the Treasuries, just to get a perspective of what's been going on. In the early 2000s up to the mid-2000s, we we had a double bottom, we had a breakout, and since then it's been off to the races to the upside. Now, in this cycle, in this current uptrend, where has it been right to be a buyer? Well, we kind of just look at this trend line here, and let me draw better. Basically, the bottom of this trend line, anywhere in this zone, you want to be a buyer. Therefore, current prices, you're looking at somewhere around here to be a buyer of treasuries. Where has it been right to be a seller? Well, kind of just drawing it and winging it, but anywhere around this line, this trend line that I drew, it's been right to be a seller. Is that going to be the case now? No, not necessarily, but it could, and if it is, being above this line is the best place to sell. And the reason why is because if it goes much higher than that, if you're shorting, that is, you can be like, okay, I'm wrong, this thing's going higher. Or, if this thing starts pressing lower, you can just jump on with an anticipation of another test back down to the bottom of the trend line. Or I should say the bottom of the channel. If I zoom in some, you can see, let me get rid of this. There's huge high volume up here, and let's actually put this in perspective. It's the point of control for the last year. And right now we're holding those levels. We've made higher lows off of those levels, and we have a flat top. So if we continue to press higher, then that's going to be good for treasuries. Treasuries are, you continue to look for upside. However, if we start rolling over and we form some type of lower high, followed by a lower low, then perhaps there's going to be a decent sell-off in treasuries, and you look at 122 or so, trading at 131 now. You look down to 122 or so as a potential target, 124, which is a decent move in treasuries to the short side. If I bring in the hourly chart, we're just getting a confirmation that this continues to be strong, and we're holding December and November's point of control. But back to the yearly chart, has it been right to be a seller at the top of this range? The answer has been yes, relative to this chart, the huge time frame chart. So it's just something to be aware of. So anyways, this is a really long video. If you've stuck around for the whole thing, thank you. I hope this helps. I hope it helps build a thesis for your trading for 2012. I hope you have a very happy new year, and I'll see you in 2012.